All right, let's dive into one of the most hyped up, but honestly one of the most misunderstood topics in the entire startup universe, valuation. It's a world filled with these just massive numbers, splashy headlines, and a whole lot of confusion.
I mean, it's the million, or let's be real, the billion-dollar question that every single founder has to answer. But how do you even begin to put a price tag on an idea, on a team, on just pure, raw potential? Well, that's exactly what we're going to break down today.
You know, we all see the news. Another unicorn hits $1 billion valuation. But for founders who are actually in the trenches, the reality of figuring out what their company is worth, well, it's a whole lot more complicated and it is full of traps. So what are we even talking about here? At its core, startup valuation is just the process of figuring out a company's total worth. But here's the key. Unlike an established business, it's not just about today's profits. It's really a blend of art and science. You're looking at things like the strength of the team, the size of the market, and any early traction you have to basically bet on its future.
And that right there brings us to our very first and probably the most common myth that so many founders fall right into. I call it the revenue trap.
I mean, it sounds logical, doesn't it? If you make more money, your company must be worth more. And that thinking comes from how we value traditional, mature companies. But for a startup, that logic can be seriously misleading.
And here's the absolute crux of it. Early-stage investors aren't buying your past performance. They are investing in your future growth. Revenue is important for sure, but it's just one piece of a much, much bigger story about where your company is going.
So, if it's not just revenue, what are investors really digging into? Well, they're asking some much deeper questions. They want to know, just how big is the market you're going after? Is this the right team to actually win that market? Do you have some kind of unique tech, a moat that protects you from competitors? And this is a huge one. Are your customers actually sticking around? And can you acquire new ones profitably? That's the whole scalability question right there.
All right, let's move on to the next big myth. This is one that taps right into every founder's ego. The idea that a bigger number is always a better number.
Let's be honest. Getting a huge valuation feels like winning. It makes for an amazing press release, and it's seen as this badge of honor in the startup world. But this obsession with getting the highest possible number, it can backfire in a really spectacular way.
The tough reality is that an over-the-top, inflated valuation is a trap. You see, smart founders and savvy investors, they know the goal isn't just the highest number they can get, it's the right number. A valuation that's defensible and sets the company up for real, sustainable growth, not for failure.
And this chart just illustrates that danger perfectly. On the left, you've got the hype. It feels like a badge of honor. You get those big headlines. But look at the right. Those are the hidden risks. That giant number sets absolutely crushing expectations for growth. It makes your next fundraising round incredibly hard because you have to show massive progress. And if you can't, you could face a really painful down round. That's when you have to raise money at a lower valuation than before, and that can just destroy morale and your credibility.
Okay, let's tackle myth number 3. This is the idea that valuation is just a simple calculation. You just plug some numbers into a spreadsheet and it spits out a final score. So many founders are out there searching for that one magic formula, that single spreadsheet that's going to tell them the correct answer for what their startup is worth. But I've got to tell you, a thing like that, it just doesn't exist.
The truth is, valuation is a dynamic process. It's not a static number. You should think of it less like a calculator and more like a toolkit, where you pull out different tools for different jobs, depending on how far along your company is.
So let's actually look inside that toolkit. This table breaks it down so well. Notice how the method changes completely based on the company's stage. At the very, very beginning, pre-seed, seed stage, it's all about the qualitative stuff. The team, the idea, the risk, that's where methods like the Berkus method come in. Then, as you grow into your Series A, you can start looking at comparable multiples, basically benchmarking yourself against similar startups. And it's only when you're a much later stage company with predictable revenue that something like a discounted cash flow, a DCF, really starts to make any sense.
And now, for the biggest, the most seductive myth of them all. This is the one that dominates headlines and founder daydreams, the unicorn illusion.
Becoming a unicorn, a startup valued at over $1 billion, is so often seen as the ultimate finish line. It's framed as the definition of success, the moment a company has truly made it.
But here is the critical distinction that we have to make. A valuation is not a measure of a company's health today. It is a reflection of what investors perceive its future potential to be.
A sky-high valuation doesn't guarantee you'll be profitable or sustainable or that you'll even survive.
This quote just nails it. You have to remember this. Valuation is a bet on the future. It is not a report card on the present. So many highly valued companies have struggled or even failed because their day-to-day operational reality could never catch up to the investor hype.
So, okay, we've busted the biggest myths. What now? How do you actually approach this in the real world? Let's shift from myth-busting to actual strategy with a clear playbook. First, be data-driven. You have to back up your big story with solid research and sound unit economics. That's knowing if you're actually making money on each customer. Second, don't just lean on one method. Use several frameworks to kind of triangulate and find a reasonable range. Third, make sure your valuation actually aligns with your strategy. The money you're raising needs to match the goals you plan to hit. And finally, just be realistic. Your credibility with investors is worth so much more than some inflated, baseless number.
So really, the most important takeaway here is to completely reframe how you think about this whole process. Your valuation isn't a final grade, it's not a report card. It's a strategic tool. It's a mechanism you use to bring in the right partners and the right amount of cash to help you build an amazing, enduring company.
And that leaves us with this one last, really essential question. Chasing a high valuation can so easily distract you from what actually matters. So you have to ask yourself, are you focused on building a big number for a press release? Or are you focused on building a genuinely high-value company that's built to last? The answer to that question will define your entire journey.